Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.
In this lesson, we'll take a look at what happens when a taxpayer donates property which has changed in value. Depending on the type of property donated, its value may have decreased or increased between the time when the taxpayer acquired it and the time that the property is contributed to a qualifying organization. A few examples of property that decreases in value are clothing, furniture, appliances, and motor vehicles. In the case of property with a fair market value less than the taxpayer's basis in it, the deduction is limited to the fair market value. If the property that is contributed has a fair market value that is more than the taxpayer's basis in the property, the taxpayer may have to reduce the fair market value by the amount of appreciation to calculate the deduction. There are different rules depending on whether the property is ordinary income property or capital gain property. If the sale of property at fair market value on the date it was contributed results in ordinary income or in short-term capital gain, it is generally considered ordinary income property. In this case, the amount of the deduction is the fair market value of the property minus the amount that would be ordinary income or short-term capital gain if the property were sold at its fair market value. If the sale of the property at its fair market value on the date of its contribution would have resulted in long-term capital gain, then the property is considered capital gain property. The general rule is to use the fair market value when calculating a deduction for a gift of capital gain property. In some situations, the fair market value must be reduced by any amount that would have been long-term capital gains if the property was sold at fair market value. This must be done if any of the following apply. The property is contributed to certain non-operating foundations. The taxpayer chooses the 50% limit instead of the special 30% limit for capital gain property. The property is qualified intellectual property. The property is tangible personal property that is put to an unrelated use by the charity. Or the property is tangible personal property that has a claimed value of more than $5,000 and is sold, traded, or otherwise disposed of by the qualified organization during the year in which the contribution was made, and the organization has not made the required certification of exempt use.
Like what you see? Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.